Look, when we talk about crushing it in real estate, the conversation almost always gravitates toward the flashy stuff, right? We're talking high profile acquisitions, massive rental income, crazy market appreciation. But today, in this explainer, we're actually going to focus on the exact opposite. We're looking at the, well, quote unquote, boring back end. We're talking about accounts payable, expense classification, and the actual financial plumbing of your portfolio. Because mastering these operations, it doesn't just keep the lights on. It literally uncovers hidden cash and acts as a massive shield against incredibly costly IRS audits. So here's our wealth protection roadmap for today. We'll be hitting 1. Mastering accounts payable. 2. Centralized versus decentralized AP. 3. Building approval workflows. 4. OpEx versus CapEx explained. And finally, 5. Passing the bar test. Basically, we're going to track the exact journey of a dollar leaving your business. All right, Section 1, Mastering Accounts Payable. If you've ever had to manage a disorganized portfolio, you know the exact pain we're solving today. The missed bills, the late fees, those strained vendor relationships, or even, worst-case scenario, contractor fraud. And that brings us to this absolutely critical insight. Disciplined AP and arrears tracking is the single highest ROI bookkeeping habit a landlord can build. It's really not just about paying your bills on time. It's about establishing rigid, non-negotiable controls to stop the bleeding and completely defend your cash flow. I want you to think of your accounts payable engine as the operational plumbing of your business. It processes every single vendor bill and manages all of your cash outflows. Now, if this plumbing leaks, maybe from poor tracking or just missing formal ledgers, your property is actively bleeding cash. And even worse, it obscures your true net operating income. It makes your property look way less profitable to lenders and buyers than it actually is. Section 2, Centralized versus Decentralized AT. So, there are two fundamental ways to structure this payment plumbing. With centralized AP, all payments run directly through headquarters. This gives you fantastic cash management and serious leverage when you're negotiating with major vendors. On the flip side, decentralized AP lets your local property managers handle their own payments. That offers lightning-fast response times, which, let's be honest, is absolutely critical if a pipe bursts at 2 a.m., and it builds really strong local vendor loyalty. So, what's the actual solution here? Well, the most successful operators usually go with a hybrid approach. They centralize the big, predictable vendor contracts at corporate, but they give local managers flexible, strictly controlled budgets to handle those urgent repairs right on the ground. Section 3. Building approval workflows. Regardless of which AP model you use, you absolutely need safe mechanics for how money moves. First, an invoice is received and verified against the initial service request. Simple enough. Second, you get local approval. That's your boots-on-the-ground property manager confirming that the work was actually completed to standard. And finally, step 3, this is your ultimate safeguard, the dual signature. By setting a strict financial threshold where 2 authorized signers have to sign off on large disbursements, you effectively build a massive firewall against unauthorized payments and contractor fraud. Moving right along to Section 4, OpEx versus CapEx explained. Okay, so now we know how the money leaves the building, but now we face a massive tax dilemma. Is replacing a roof a repair or is it an improvement? Think about it. Every single time you cut a check to a contractor, you've got to ask yourself, can I deduct this today, or is the IRS going to force me to depreciate this over decades? Getting this wrong isn't just a minor oops, it is a wildly expensive mistake. So here is the great divide. Operating expenses, or OpEx, are your routine maintenance costs. Think of, fixing a broken window or patching a couple of missing shingles. You get to immediately deduct this in the current year, which lowers your taxable income right now. Capital expenditures, on the other hand, CapEx, materially add value or extend the life of the property. Think of tearing off and replacing that entire roof. Those big-ticket items, they must be capitalized. Now, you might be wondering, why does this classification matter so much? Take a look at this number, 27.5. For residential rental properties, a capital improvement has to be depreciated over 27.5 years. If you spent $30,000 on a brand new roof, you don't get a $30,000 deduction this year. Nope. Instead, you get to deduct a measly $1,091 every year for nearly 3 decades. That is a massive cash flow hit today compared to an immediate OpEx deduction. And oh man, if you're dealing in commercial real estate, brace yourself, because that timeline extends even further to 39 years. You are locked into spreading that cost out over an incredibly long time horizon. It makes upfront cash flow management absolutely vital. Naturally, as landlords, we kind of want to classify everything as a routine repair just to get that sweet, immediate tax deduction, right? But
Be warned, misclassifying a CapEx item as a repair is literally one of the most common IRS audit triggers in rental property reporting. Precise classification isn't just about saving a few bucks today, it is about completely bulletproofing your operations against severe IRS scrutiny tomorrow.
Which brings us to Section 5, passing the bar test. Fortunately, the IRS doesn't just leave us in the dark to blindly guess what's a repair and what's an improvement. Enter the IRS BAR test. That's BAR. It stands for Betterment, Adaptation, and Restoration. If the money you spent on your property hits any of these three criteria, you lose that immediate deduction. It absolutely must be capitalized as an improvement. So let's quickly break these down one by one. First up is betterment. The IRS defines this as materially increasing the capacity, productivity, efficiency, strength, or quality of a property. Essentially, if you're making the property objectively better than it was before the condition arose, you're looking at a betterment. A really perfect rapid-fire example of betterment is replacing an old-school, standard water heater with a brand-new, highly efficient tankless system. You didn't just fix a broken heater, right? You materially increase the efficiency and the quality of the property's plumbing system. That, for sure, is a capital improvement. Next is adaptation. This happens when you convert a property to a new or different use that is completely inconsistent with its original intended purpose. So, for example, if you take a standard residential apartment building and you pour money into converting those units into commercial office spaces, you are adapting the property. Every single dollar spent on that conversion has to be capitalized. And finally, restoration. This is when you return a property to operating condition after it has completely deteriorated to a state of disrepair, or when you replace a major structural component. Going back to our earlier example, patching a few shingles, repair. But replacing the entire roof or completely rebuilding a major structural foundation, that restores a property's life, and you guessed it, it must be capitalized. Now here's where things get kind of tricky. Real estate projects are often mixed, right? What if you upgrade bathroom fixtures, which is a capital improvement, but you also fix an unrelated hole in the drywall during that exact same week? Well, the drywall is a repair. But if you repaint the entire bathroom as part of the new fixture installation, that paint job suddenly gets sucked right into the capital improvement. To survive an audit, you absolutely must maintain pristine records, separate invoices, and honestly, even before and after photos to legally separate your independent repairs from your CapEx projects. So let's pull the whole shebang together into your wealth protection playbook. 1. Implement strict AP workflows so you don't leak cash. 2. Enforce dual signatures to totally eliminate fraud. 3. Master the difference between OpEx and CapEx to optimize your taxes. And 4. Always diligently apply that IRS BAR test before you expense a major project. Honestly, controlling your financial plumbing directly translates to a highly profitable bottom line. I want to leave you with this final, somewhat provocative thought. If the IRS audited your property ledgers today, would your financial plumbing actually hold water, or would your cash flow just leak away? Take a really hard look at your accounting systems. Tighten up those workflows and make sure every single dollar is tracked, protected, and properly classified. Thank you so much for joining me for this explainer, and I will see you in the next one.